Most people believe their money is safe because the government says so. That belief alone has bankrupted more families than any market crash in history. There is a pattern. Institutions promise safety, regulators look away, and ordinary people pay the price, quietly, slowly, with their life savings. This is not a story about criminals in dark alleys. This is a story about men in suits, in boardrooms, who gambled with your deposits and won. And when it all collapsed, the bill was sent not to them, to you, to every tax-paying family in America. $1,200 per person. Today, I want to walk you through exactly how it happened, because the same machinery that caused it is still running, and your retirement may be closer to it than you think. This is the story of the savings and loan crisis. Over 1,000 institutions, $500 billion, and a bailout so large the government hid it for years. To understand this crisis, you must go back to the 1930s. After the Great Depression, America created savings and loan associations, simple institutions with one purpose: take deposits from working families, offer them safety, then lend that money out as home mortgages. Slow, simple, regulated. It worked for 40 years. Then came the 1970s. Inflation exploded. Interest rates soared, and suddenly these S&Ls were trapped, paying high rates on deposits, earning low rates on old mortgages. They were bleeding money, slowly, quietly, and Washington knew. Instead of closing them down, they made a fateful decision. They deregulated them instead. In 1982, Congress passed the Garn-St. Germain Act. With a stroke of a pen, S&Ls were freed to invest in almost anything: commercial real estate, junk bonds, risky ventures. At the same time, deposit insurance was raised to $100,000 per account. This was the fatal combination. Institutions could gamble freely with zero personal risk. Economists call this moral hazard. When you remove consequences from risk-taking, you guarantee recklessness, and recklessness at scale becomes catastrophe. S&L executives began lending to developers building luxury hotels, golf courses, and shopping malls in markets that had no demand. The appraisals were fraudulent, the loans were certain to fail. In Texas alone, real estate values collapsed by 40%. Entire S&L portfolios became worthless overnight, but the executives had already collected their bonuses and walked away. By the mid-1980s, regulators began discovering the scale of the disaster. But here is where the story turns darker. Many regulators were pressured, politically, to look away. 5 sitting U.S. senators intervened directly on behalf of one failing institution. They became known as the Keating Five. It was one of the most brazen acts of political corruption in financial history. That single institution, Lincoln Savings, cost American taxpayers over $3 billion alone. Its depositors, many of them retirees, lost everything they had saved over a lifetime. By 1989, the crisis could no longer be hidden. Over 1,000 savings and loan institutions had failed. The total cost to resolve the collapse, $500 billion, the largest financial bailout in American history to that point. Congress created the Resolution Trust Corporation to sell off the toxic assets. They auctioned billions in real estate, loans, and holdings at pennies on the dollar. Sophisticated buyers grew enormously wealthy. Ordinary depositors got nothing. Now you may be thinking, that was the 1980s, ancient history. But I want you to pause here, because the machinery that caused this disaster was never dismantled. It was simply rebranded. If you are in your 40s, 50s, or 60s today, you have lived through 3 versions of this same crisis: the S&L collapse, the dot-com crash, the 2008 mortgage meltdown. Same pattern, different costume. Each time, deregulation came first, then euphoria, then reckless lending, then collapse, then the bill, sent quietly to you through inflation, taxation, and destroyed purchasing power. The S&L crisis did not announce itself. There was no siren, no warning on television. Families simply went to their branch one morning and found it closed, their life savings frozen. That is the nature of institutional collapse. It is always gradual until it is suddenly total. and the people least prepared are always those who trusted the most. Today, regional banks are under pressure. Commercial real estate loans are souring. Interest rate spreads are squeezing institutions. The echoes of the 1980s are not subtle, they are loud. This is not pessimism. This is pattern recognition. And pattern recognition applied early is the single greatest wealth preservation tool available to any investor over 40. The families who survived the S&L crisis with their wealth intact were not the smartest. They were not the richest. They were simply the ones who understood the rules of institutional failure before it arrived. So now, let us extract those rules. I call them the laws of survival. 7 principles distilled from the wreckage of over 1,000 failed institutions and the families they took down with them. These are not theories. They are lessons carved from real losses, real families, and real consequences. Pay attention. Your retirement may depend on how seriously you take what comes next. Law number 1. Never confuse deposit insurance with actual safety. The S&L crisis proved that insurance is only as strong as the government's willingness and ability to honor it. The Federal Savings and Loan Insurance Corporation, the FSLIC, was supposed to protect depositors. By 1987, it was itself insolvent. The insurer had gone bankrupt. When the safety net itself collapsed, Congress had to bail out the bailout fund. Taxpayers paid twice, once for the failed institutions, once for the failed insurance that was supposed to protect them. The practical lesson: never hold more than the insured limit in any single institution. Spread your deposits. Never assume the ceiling is a guarantee. It is only a promise, and promises have conditions. Law number 2. When governments deregulate financial institutions, do not celebrate, prepare. Deregulation is historically the first domino in every major financial collapse. In 1982, deregulation was sold as freedom and innovation. Within 6 years, it had produced the largest peacetime financial disaster in American history. The language of freedom masked the removal of protection. Every major deregulation cycle ends the same way: euphoria in year 1, excess in year 3, collapse in year 5, taxpayer bailout in year 6. Study the cycle. You will never be surprised again. When you hear that banks are being given new freedoms, new products, new markets to enter, that is your signal. Quietly review your exposure. Quietly reduce your concentration. Move before the crowd does. The wealthy families who survived the S&L crisis with their wealth intact were not lucky. They read the regulatory environment like a weather forecast, and they dressed accordingly before the storm arrived. This is not about fear. It is about calibration. The investor who understands regulatory cycles does not panic. He simply positions himself one chapter ahead of the crowd. That gap is where generational wealth is built. Law number 3. Real estate is not the unconditional safe haven your parents told you it was. The S&L crisis proved that property values can collapse with terrifying speed when credit dries up. During the S&L collapse, commercial real estate values in some American markets fell 40 to 60% within 24 months. Not gradually, suddenly. Developers who borrowed at peak valuations were instantly underwater. The critical lesson is real estate derives its value from available credit. When credit contracts, property values follow, always, without exception. The asset does not protect you if the financing collapses around it. Before you buy any property today, ask one question. If credit tightens by 30%, what happens to the value of this asset? If the answer frightens you, that is your answer. Walk away. The survivors of the S&L era who held real estate wisely shared one discipline. They never borrowed to the maximum. They always maintained equity buffers. They treated leverage as a tool, never as a strategy. Law number 4. Political risk is not something that happens in other countries. It lives quietly inside your portfolio. In every regulated industry, every government-backed institution, every interest rate decision. The Keating 5 scandal revealed something every investor must internalize. Powerful institutions do not fail because of markets alone. They fail because of decisions made in rooms where no market force can reach. 5 senators delayed the closure of a failing institution for 2 years. That delay cost taxpayers an additional $2 billion. Political intervention in financial markets always has a price, and you always pay it. Practical application: when you see heavy political involvement in any financial sector, bailouts, emergency legislation, rate interventions, treat it as a warning signal, not a rescue signal. The rescue always comes with a hidden cost. The most dangerous moment in any financial crisis is when politicians announce they have it under control. That announcement is historically the signal that the situation is far worse than disclosed. Reduce exposure, quietly, immediately. Law number 5. Fraud does not arrive wearing a mask. It arrives wearing a suit, carrying audited financial statements and speaking the language of confidence and growth. During the S&L crisis, hundreds of institutions reported healthy profits while secretly insolvent. Auditors signed off, regulators approved, executives collected bonuses. The fraud was hiding inside the paperwork everyone trusted. One institution in California reported $51 million in profits the year before it collapsed with a $2 billion deficit. The gap between reported reality and actual reality was not a rounding error. It was a deliberate construction. The practical rule: when an institution's reported profits seem inconsistent with the economic environment around it, trust the environment. Markets do not lie. Accounting departments sometimes do. Always ask, how is this institution making money in this environment? If the answer requires more than 2 sentences to explain, that complexity is the fraud. Legitimate businesses are simple. Schemes require elaborate justification. 3 questions every investor over 40 must ask before placing money anywhere. Where exactly is my money held? Who audits this institution independently? And what happens to my funds if this entity closes tomorrow? Law number 6. Institutional trust is the most expensive emotion in personal finance. The families who lost everything in the S&L crisis had one thing in common: they trusted completely and verified never. These were not naive people. They were doctors, teachers, business owners, retirees, educated, hard-working Americans who believed that a federally chartered institution was synonymous with security. It was not. Trust is not a financial strategy. Verification is. Diversification is. Understanding is. The moment you stop asking questions about where your money is the moment you become the most vulnerable person in the room. The discipline is simple. Every year, without exception, review every institution holding your money. Ask for documentation, request statements, understand the fee structures. Complacency in wealth management is not peace, it is exposure. Law number 7. Concentration is the silent wealth killer. Not market crashes, not recessions, concentration. Putting too much into one institution, one asset class, one geography is how ordinary families lose generational wealth overnight. During the S&L crisis, entire communities banked with a single local institution. When that institution failed, the economic damage was total. Businesses could not make payroll. Families could not access savings. Life stopped. Concentration risk is invisible during good times. Your single institution performs well. Your single asset class appreciates. Your confidence grows. And then the environment shifts and everything moves against you simultaneously. The antidote is not complexity. It is structured simplicity. Hold deposits across multiple institutions. Hold assets across multiple classes. Hold investments across multiple geographies. Boring? Yes. Catastrophe-proof? Also yes. A practical framework. No single bank should hold more than your insured limit. No single asset class should represent more than 30% of your net worth. No single country's economy should determine your financial fate. The families who emerged from the S&L crisis financially intact were not the wealthiest going in. They were the most distributed. Wealth spread across multiple pillars does not fall when one pillar cracks. It simply leans and recovers. We have covered 7 laws carved from one of history's most consequential financial disasters. But I want to leave you with something deeper than strategy. I want to talk about what money is actually for. Every family that lost their savings in the S&L crisis lost more than money. They lost options. The option to retire with dignity. The option to help their children. The option to face illness without panic. Money is stored freedom. When institutions fail, they do not just take deposits, they take the years behind those deposits. the decades of discipline, sacrifice, and deferred gratification. That is what makes financial negligence, institutional or personal, a moral failure. This is why financial wisdom is not optional for anyone over 40. You are no longer building, you are preserving. And preservation requires a different discipline, more deliberate, more defensive, more clear-eyed about risk. The greatest financial mistake a person over 40 can make is assuming that the hard part is over. The hard part is never over. But with the right framework, it becomes manageable, and manageable is enough to win. The S&L crisis was not inevitable. It was a choice, a series of small choices made by regulators, executives, and politicians, each one individually defensible, collectively catastrophic. Crisis is always a product of accumulated decisions. Your financial life is also a product of accumulated decisions. Every year you delay diversification. Every year you leave excess deposits in a single institution. Every year you trust without verifying. Those are your dominoes being set up. But here is the profound truth the S&L survivors understood. You do not need to predict the crisis. You only need to be structurally prepared for it. Preparation is not pessimism. It is the highest form of financial optimism. Think about what financial security actually gives your family. It gives your spouse peace of mind at 3 a.m. It gives your children a foundation they didn't have to build from scratch. It gives you the dignity of choosing, not the desperation of accepting. The retirees who lost everything in the S&L crisis lost because they didn't know that institutions could fail, that regulators could be captured, that insurance could become insolvent. You now know what they did not. That knowledge carries responsibility. The responsibility to act on it, to review your holdings, to restructure your exposure, to have the conversations with your family that most people never have. Financial wisdom is not inherited, it is transmitted, deliberately, intentionally. The families who thrive across generations are not the ones with the most money, they are the ones with the most clearly understood principles about how to keep it. So let the S&L crisis be your teacher. Let its 1,000 failed institutions, its defrauded retirees, its corrupted regulators serve a purpose beyond their original tragedy. Let them teach you what no financial advisor will ever say plainly enough. Your money represents your life's work. Protect it with the same seriousness with which you earned it. Not with fear, with knowledge, with structure, with the quiet, unshakable discipline of someone who has already learned from those who lost everything.